This week on Wealth Track, financial thought leader Jason Trennert and his team at Strategas Research Partners mix investment formulas to profit by, including TINA, the Thrifty 50, and the new sovereigns. What he is cooking up now is next on Consuelo Mack Wealth Track. I asked Trennert why, despite the long bull market, he thinks U.S. stocks are still a good place to invest.
Well, I would say the irony is that although the bull market's 7 years old, in many ways it's the bull market no one's loved, especially among individual investors. If you look at the flows into mutual funds and into ETFs, there's actually been net redemptions from U.S. stock funds over the last 7 years. I know it's hard to believe because the market's tripled, but the flows into international equities and into bonds have been much, much greater. And to me, that's where really more of the risk lies. And the reason why common stocks in the U.S. look attractive to me is that they're still largely under-owned, especially among individuals.
Even after the kind of appreciation that we've seen, you still think it's not too late to get in?
I don't think so at all, especially for large, well-capitalized companies. Because you're looking, I would say, at an S&P 500 that might be trading at about 15 times earnings.
Right, not cheap.
It's not cheap, but if you look at bonds, a 10-year Treasury bond will give you 2%. And that way it's trading in some ways at 50 times earnings.
Right.
With no potential for growth and a lot of potential for capital risk. I think one of the things that bothers me a little bit about bond funds is that people are assuming that it's a good proxy for cash. What you've seen is a big decline, a big redemption in money market funds, a big increase in bond funds. Those two products are not the same. They're not, a bond fund is not a good proxy for cash. You can lose principal. On the equity market side, there are many companies actually, some of the best companies in the U.S. actually have better credit ratings, if you look at certain measures, than a lot of sovereign countries. Like
and talk about this, because at Strategas, you come up with these wonderful names and concepts, and you have the Thrifty 50. So explain what the Thrifty 50 is.
We call it the Thrifty 50. It sounds a little complex, but we're essentially looking at what the insurance rates of a default on their bonds are.
Right.
And we compare them to what the insurance rate of a default on government debt is. And believe it or not, there are about 75 companies in the United States that have lower insurance rates
and so therefore deem better
credits than Japan. There are 54 that have better rates than France. So in many ways, they're new sovereigns. They actually could be seen as proxies for sovereign debt, which would normally be seen as the risk-free asset. In today's world, actually with governments having so much debt, a lot of companies have something that a lot of governments don't have. They have money. And so, which is helpful when you're trying to pay a dividend. So in my view, there actually is less risk in some of the largest, best capitalized companies.
And these, Thrifty 50, I'm just looking at my notes here. So, I mean, they're names like Apple and Colgate and Chevron and ExxonMobil and Google, J&J, Merck, Walmart. So they're a whole wide spectrum of companies, of large companies. Should we treat those as a bond equivalent?
To me, absolutely. And I think that if you look at the performance of that group of companies in relation to the market as a whole, they've outperformed in a relatively big way.
Right.
And I also think, you're taking far less risk. All those companies provide dividends. Virtually all of them provide dividends. You're taking much less risk than you are, I think, in buying sovereign debt or lending the U.S. government money or other governments' money at extraordinarily low interest rates for long periods of time. So in my view, again, it depends on your comfort level, but I think I always get nervous when people think they're taking no risk when in fact they're taking a lot of risk when they're investing in treasury or sovereign debt.